In 1850, U.S. whale hunting was booming. Whaling is risky but lucrative. Even though 1/3 of ships don't return, successful trips return 10 times the initial investment. So wealthy people spread their bets across whalers to reduce risk. Many investors become wealthy, but the U.S. switches to petroleum. John D. Rockefeller became wealthy and founded the Standard Oil Company during the oil boom. Rockefeller's children sought new investments in 1946. They invest in risky startups, but think like benefactors. Boston pioneered startup investing. ARD funds several defense technology startups. It proves its concept. ARD startups had to give up 70% of the company in exchange for investment. Since the R&D investment fund is incorporated rather than a partnership, the SEC may audit it. San Francisco stockbrokers were investing in new tech on the other side of the country. They're nameless. That's why it's called The Group. Founder invests $15,000 in a tape recorder firm and makes $1 million, so they're good at investing even if they're bad at brand names. In the 60s, futurists saw that analog technology would fail and that everything digital would need semiconductor chips. William Shockley employs all top engineers. Shockley Semiconductor is his semiconductor company. Shockley is a lousy boss, and 8 of his best employees departed to become traders. New venture capitalist Arthur Rock names Fairchild Semiconductor the Trader's 8 and sponsors its launch. It's promising. The U.S. government has noticed Silicon Valley's semiconductor production. The U.S. needs cutting-edge technology to win the space race and Cold War. They help startup investing SBICs this way. However, funds must be $450,000 or more. No startup can receive more than $60,000. The market must meet demand since no one wants to labor under government constraints. Even though he only made $700,000 with the Trader's 8, Arthur Rock proved that encouraging talented scientists to try something new may lead to major advances. He bet more. Rock noticed something others didn't. A home run would erase the mistakes of most new attempts. This small conceptual shift would change startup financing. It's 1968. Rock has the model. He also beats Warren Buffett's record by approximately 22 times his initial investment. Rock now understands the power law. Early-stage investors think differently. He helps 2 of the merchant's 8 launch Intel again. Rock's reign was limited by 2 new venture capitalists. 1972 saw 2 notable venture capital firms. Valentine founded Sequoia Capital and Kleiner Perkins. Both worked at Fairchild Semiconductor, where they saw how venture funding drives innovation. One fundamental question remains: how close should traditional venture capitalists and startups work? VCs funded and let engineers develop and build. In 1973, Sutter Hill created the Q model, pairing a great innovator with a powerful external CEO to expand the company and test the hypothesis. Don Valentine invests in Zari, a game startup with cutting-edge technology, but poor logistics. Kleiner Perkins builds Tandem Computers in-house. Spin it off into its own firm. Silicon Valley is more than just the computer chip business. To commercialize recombinant DNA technology, Kleiner Perkins funds Genentech. It's a risk, but Kleiner sets a new norm for companies that need a lot of money at once by investing in it gradually. Our first ubiquitous brand arrived in 1977. Apple Computer. Thus, venture capitalists reject Steve Jobs' investment proposals. However, Silicon Valley has a large investor community, so if one VC says no, you can try another. 3 years later, Apple and Genentech went public, giving shareholders significant gains. Silicon Valley residents want to bet more on venture capital. The East Coast is awake. Silicon Valley dominates venture money, but the East Coast is seeing more corporate partners. Consider Bob Mikkel. He invented the Internet's Ethernet wire, but East Coast VCs wouldn't support him. Thus, we founded his Silicon Valley business, California is flourishing, but investors must decide. Venture capitalists have already invested in several promising technology. However, Arthur Patterson and Jim Schwartz establish Excel Capital to target specific markets. Cell will focus on telecom the following week instead of semiconductors or biotech. Silicon Valley's 1980s were its best. Tech industry growth and recent tax and banking reforms have benefited the venture capital model. Pension fund managers can invest in startups once capital gains taxes were cut. In 6 years, VC funding quadrupled to $12 billion. In 1987, Sequoia makes a significant Cisco investment, but changes the management team. Venture capital firms have grown rich and influential, reviving the argument over how much control investors should have over the companies they back. Sequoia became the first venture capital firm to make over $100 million from a single investment. This would force founders to rethink their power retention techniques in future Silicon Valley booms and collapses. Temperature rises quickly. The 1990s. Go, backed by John Doerr, fails to produce an iPad. However, power law has led the VC industry to fully accept the strategy of swinging for the fences. The 90s are the perfect time to adopt a limitless upside attitude toward venture capital investments. EUNet, supported by Excel, NEA, and Menlo Ventures, provides citizens with a government-run internet. Despite the internet's infancy, Kleiner Perkins funds Netscape's innovative browser. Internet weaknesses remain. Finding things is hard. Sequoia's 1995 Yahoo investment boosted the search engine business. Silicon Valley recognizes search's future importance, and worldwide investors are excited. Masayoshi's son, who inherited a fortune, offers Yahoo $100 million for a stake. Yahoo has doubts. They've never done this before, but a competitor with $100 million in the bank worries them, so they steal it. Growth investing has stirred up. John Doerr again gets Kleiner Perkins in early and profits from the Amazon acquisition. Silicon Valley's top internet investor will soon be challenged by many VCs. eBay is the 90s next big thing. Auction website growth is unprecedented. Bob Kagle's first investment is amazing. Most VC firms aim to raise more money. Benchmark maintains efficiency and concentration, realizing the $5 billion eBay investment benefit. Traditional venture capital businesses are struggling. Silicon Valley, home to many successful companies, now allows individuals to directly aid startups. Sergey and Larry Page raised $1 million from angel donors before approaching venture capitalists, indicating a shift in startup finance. In 1999, Larry and Sergey, engineers, imposed hard conditions on Kleiner Perkins and Sequoia, launching the age of the fully empowered tech founder. 2 other businesses sought the full series around, but the Google founders utilized their leverage. New companies struggle to hire top talent. Stock options let small companies compete with larger ones in salaries. A talented engineer may receive a large stake in the company without any tax burden to the corporation. Stock options fueled creativity in Silicon Valley, but their revolutionary power was known. After financing Alibaba, Goldman Sachs moved to China. In the new millennium, the internet sector is crucial. Technology has reached new heights due to Y2K computer faults. VC firms handle $104 billion, but the dot-com bust will cause problems. Suddenly, it becomes apparent that not enough people are using this amazing technology. Sums don't add up. Dot-com bubble bursts market. Astute bankers know this cutting-edge innovation will succeed, so it doesn't matter. Thus, major players change. SoftBank's Alibaba profits more than offset its U.S. technology market losses. Tiger Global led hedge funds in investing in startups. Post.com crash technology has rebounded. Google's dual-class share structure ensured that the founders would retain control after going public. It's becoming clear that great founders can see their firm's growth across decades. In 2005, Peter Thiel founded the Founders Fund. He's not the only venture capitalist to focus on founders' long-term success, but he's not alone in business model innovation. Paul Graham established business incubators by launching Y Combinator with Jessica Livingston. They invest in potential firms before VCs and prioritize those with great technological skills. Facebook is also changing Silicon Valley culture. Mark Zuckerberg pitches Silicon Valley investors in pajamas in the mid-2000s and gets term sheets. Yuri Milner helps Zuckerberg after 5 years of steady growth. When most tech businesses go public, Milner knew Facebook would succeed, unlike a typical IPO. Accept a large growth equity round to stay hidden. Technology businesses' success has made this path ubiquitous. Mark Andreessen and Ben Horowitz start a venture capital firm around the end of the decade. Andreessen Horowitz is called a 16s because it's easy to say. Mark and Ben decided to model themselves after CIAA, a big Hollywood talent agency, and a reminder of how Sequoia was blocked from getting a controlling position in Google's Series A. Startups are a game of who you know. It's 2010. Meituan, a Chinese e-commerce company, lost less money than Google. By 2013, the U.S. tech industry was still growing despite China's record earnings. Late-stage digital businesses worth over $1 billion require a new phrase. Does unicorn work? So that's rare. They wouldn't last long. Masa introduced the $100 billion Vision Fund that year. If it has great growth rates, a company can stay secret for years and raise hundreds of millions of dollars. Unicorns appear overnight. Sequoia dislikes its business changes. Mike Moritz worries that cheap funding would distort technology investment markets. Sequoia's $8 billion expansion fund addresses this. Venture capitalists have more capital than ever, creating new opportunities. Elon Musk proved that a founder can disrupt any industry after decades of work. Palantir and SpaceX, founders fund portfolio firms, observed this firsthand. Thus, they're going back under the oil. Startup founders can get multi-billion-dollar VC funding without giving up equity. Problems complicate everything, but smooth operations benefit everyone financially. That's all for today. If you like the video, subscribe to our channel Think Insider, and don't forget to hit the bell icon.